You said you have something after this?
Yes.
An appointment?
Yeah, but it's okay. I rearrange everything. Good morning, everyone. Happy Wednesday. Today is September 24th, 25. The people who have not seen me or have not heard of me or know me, my name is Aida Tazara. I am a licensed real estate agent in the state of Minnesota, with Coldwell Banker, and as well as I with Gojo. My company name is Gojo. I own it. This and that. So I am a team lead, and also I do commercial as as a residential as well, and do a lot of different stuff in real estate. The other one that I do, I manage properties as well. So today we mainly are talking about refinance. Refinance, it's been a lot of question. It's been a lot of, anytime you turn on any kind of social media, we hear that it's a good time refinance. Refinance. What is refinance? A lot of people have a lot of misconception about refinance. So today we literally wanted to dig out what is refinancing, what are the stuff that the client should bring. And we talk about a bunch of stuff for like an hour and a half or two. So if you have never ever met Peter Jerf, he will tell you who he is. If you can, please tap the screen as you guys are listening this, and it will help us out, for us not to get stuck, or that we don't have to have Peter to drop and then he has to come up. So let's rock and roll. I will mute myself. Go ahead, Peter. And then after you explain yourself, would you please let us know about the market today, where we at, and then we go from there.
Yep. So I'm Peter Jerf with Custom Made Mortgages. We are licensed in the state of Minnesota only. And anything we're talking about today is for educational purposes. These are not quotes. These are not promises, anything like that. So if you guys want a quote, definitely reach out. We can do that for you. But this is for educational purposes only. So as far as the market today, rates, most lenders open very slightly worse than where they were yesterday. I know last week we talked about the Federal Reserve cutting interest rates. Again, they do not directly control mortgage rates. Since they cut, let's see where we were last week was the 27th? Or not the 27th, the 17th?
17.
Yeah. So we were probably, let me just look at this. So we're probably down, or the rates are probably worse by, open out 101.25. We're down like maybe 30 basis points, or like 1/3%, roughly, depending on the lender, since they cut those rates, which means the rates got worse since then. And the big reason for that is the market front loads these things. So it was about a 99% chance likely that they were going to cut 25 basis points, which they did. So all the lenders had already priced that into their rates ahead of time. If they had done 50 basis points, that might have been different. But the other big thing, and I know we talked about this more last week, this week we're talking about refinancing, but rates are obviously a big part of all of this, is the market, who buys and sells the mortgage-backed securities, how the 10-year treasury affects it. There's many things that affect mortgage rates. And so even if they'd cut 50 basis points, we might have seen a negative reaction like we saw last year. So, but it does look like these are going to be coming down over the next 2 years. How fast is the big question. Fannie Mae came out yesterday and they updated their expectations, saying that they think they're going to come down another 0.1% by the end of next year. I think they went from 6% down to 5.9%. So very small difference. And when the rates move, a lot of times people ask us like, oh, did they drop from 6.5 to 6% today? For a move like that, you'd have to have a really, really bad, something really big happen, usually bad. So again, they move very incrementally, very small movements, daily, even month to month. So as far as refinancing, which we're going to talk about today, obviously this is a big part of it. Since that rate cut happened, I've had a lot of people calling me, texting me, emailing me, saying, hey, I heard the rates got cut. And now, and there's a couple people I knew wanted to refinance, so I reached out to them. And the funny thing is, 2 of them did not return my calls, texts, anything until after that cut happened. So we're still looking at it, but the rates are actually worse because they waited for the news. And that's the biggest thing I can say. If you're getting your mortgage news or your real estate news from just regular media like CNN, Fox News, that type of thing, it's probably not very, very accurate. So, yeah. But yeah, so today now it's 5 basis points, so very minimal change for how most lenders are going to price today. And unless there's a decent sized movement later today, we'll probably be where we are because most lenders release pricing around 8 to 9 a.m. Central Time. Yep. And so I doubt there'll be much of a movement in the rates the rest of the day unless there's something that comes in and influences it. Because the lenders do not change with every basis point, every 1/100%. They change usually every like 15 to 20 basis points. So, yeah, so that's my little spiel on the rates right there.
Perfect. So, that last week we both had bombarded with a bunch of calls with the refinancing, especially people who purchased, last year, a year before. A lot of people purchased property, 7%, 7.2, 6.9, even close to 8. And so, yes, refinance, it is a good thing to do to drop your monthly payments. And that is like one of the things that we all do. And I have done it, a couple of times. So when someone wants to do refinancing, or if they call you, say, hey, I wanted to refinance, what is the requirement that they should be ready before they even wanted to refinance their property?
Yep. So no, that's a fantastic question. So, and that's a good reminder because a lot of people tend to, maybe it's more subconscious, but think, hey, when I want to refinance, I'm just going to make a call. I'll get it done. Boom, boom, boom. It's finished. A refinance, by definition, is you are paying off your old loan and you are starting a new one. So a lot of people think they're just changing the terms of their current loan. But if you think about it like a car, it's like you're taking the car back to the dealership and trading it for a new one. So new terms, new requirements, new everything, new payment. So you do have to qualify for that. Now, depending on the type of loan you have, depends on how in-depth that is. Also, there could be other factors involved as far as such as like if you have your house significantly paid off, like let's say half the value is paid off, so it's worth $400,000, your loan is $200,000. That refinance is going to be a lot easier than somebody who just bought their house last year and they've only paid off 3.5% of what the worth is, because then you only have about 3.5% equity. So the lenders they have a little bit more scrutiny. Now, it is usually easier than the purchase process because you already own the home. So that is a very different situation. But we still have to look at credit for pretty much every type of loan. We still have to look at, for most refinances, we have to look at your income, your debt, your mortgage payment history, regardless of the type of loan. You have to look at that, and that's a big thing. I always tell people, try to avoid ever having a 30-day late on your mortgage. It will hurt your credit a lot, but it will also make the lenders less likely to want to just approve that refinance, because they don't want to approve something that then ends up, especially if they are not the original lender, that currently has that loan. If you're with a different lender or servicer and you've been having difficulty making payments, if you've been having difficulty making payments to Ida for debt that you owe her, and then you come to me and say, hey, Peter, you have a little bit cheaper interest rate. I want to refinance and pay Ida off, and I want to loan your money. And then I talk to Ida, and she goes, well, yeah, John's missed his payment 6 of the last 12 months. I'm not going to want to lend you money because I know I'm going to have to chase you, and you might not pay me back, and all those other things. So just like a purchase, assume that we're going to have to look at your income, your debt, your assets, maybe depending on if you're spending any money, your credit, your property value, the loan type, the condition of the property, of the home itself. So don't trash the house. And then again, the specifics are going to depend on your situation and also the loan type and also the property type. So, I won't go into each one because that'd take a while, but it's not just a slam dunk where you just call somebody up and they're just, oh yeah, let's quick change the interest rate number. And then everything else is the same. So as far as qualifying, that is a big part of it. Do you want me to go into like a few other factors?
No, hold on in there. So what was the reason that you said don't trash? Are they gonna get an appraisal as well? And the appraisal will go on their property, check the property before they even change the loan?
Correct. Some refinances you can get an appraisal waiver. Some refinances you can't. Rarely does that depend on the lender. Usually it's more the entity behind the loan. So whether you have FHA loan to the government, VA loan, USDA, those are all government loans. And then for conventional, those are Fannie and Freddie. So that are behind them. So again, a lot of times we're seeing people get appraisal waivers right now, but it's not guaranteed. And you can lose the appraisal waiver throughout the process. So you could start out with one, something could come up throughout the process, and then the lender could say, you know what, because this came up, now we have to go ahead and do an actual appraisal, send somebody to your property, and that type of thing. So, and they're not going to look at, the color of the carpet or the aesthetics and how well the house is updated, but they're going to be looking at the quality of it, just like when you purchased from a value standpoint. So you don't need to, vacuum every room and hire professional cleaners, but you definitely don't want to have holes in the wall. You don't want to have, the front doors messed up, and, you got bedrooms that got, the roof sagging because there's a water leak, and now all of a sudden you got issues from that. So they will look at those things. Again, they're not a handyman, but they're looking at the value as if somebody came to buy this house today, how much do we think professionally, from our opinion, what we know as houses, what this house would be worth on the open market. So yeah, that's a big key. And I even had somebody a couple of years ago called me to refinance, and he was in the middle of doing a remodel on his house. He was doing it, most of the work himself. So the railings were ripped out, the carpet was ripped out. And, so it's going to be hard for the appraiser in that situation to truly evaluate it because they don't even know what's going on. And it also wasn't very safe to even walk through the house because there was nails everywhere and things like that, staples. Anyways, long story short, he finished the remodel. Also, I told him, if you finish that, your home's probably going to go up in value because now you've put in new carpets and railings. You went from old metal railings to really nice wood ones. Things like that. So that will increase the value as well, which will help you in that situation. So he waited, got it done. We did a refinance a month later or something like that. The interest rates really hadn't changed much. So everything worked out. But yes, so the property condition is important. And when you sign the loan documents, when you purchase it, there is an addendum in there usually, pretty much always, that says that you're not going to store like toxic chemicals and you're not going to destroy the property, because the bank is lending you that money under the assumption that the home is still going to be worth what you paid for it, if not going up, depending on the market. But yeah, they're going to assume that you're still going to take care of it.
Okay, perfect. So Another question that I have for you is a lot of people think that refinancing, when you do refinance, or there's a lot of companies that who is advertising right now saying refinance is free. And
Yeah.
I know for a fact that there's nothing is free, right? But we keep seeing that. I have a couple of people that actually send me a screenshot of the ad that they got, and some of them actually share me what they have seen on TikTok. So, what does that mean? What is? Are there any free stuff that you have, like a program that I can refinance my house, so when the property, when the interest rates go down? And I think we wanted to know this thing. A lot of people ask, whenever people say free, we want it to be, we wanted to get stuff for free. We're human, right?
Yeah.
So what does that mean when they said it's free at free refinancing? And then before you answer that, I would like you to guys to help me to copy link and plus tap the screen at least to get to like 5,000. I would appreciate it, my TikTok family. Go ahead, Peter.
Yeah, so no, that's a fantastic question, and it's something that drives me a little crazy because we're talking to my compliance company. We're not supposed to say that because it's deceptive advertising. We'll put it that way.
Yeah.
But again, I'm not going to accuse anybody of that because depending on the structure of your company, there could be a way to give you what looks like on paper is a free refinance. So I won't get into the structure of the businesses involved in lending and originating mortgages. But basically what's happening there is, let's say the current interest rate is 5.75%. You have title fees. Usually it's going to depend on the loan amount, that how much those title fees ultimately are. You have government fees that you have to pay them on every transaction. You also have usually it's only about $46, but you have a filing fee with the county to update the paperwork that they have. And then you also have the lender fees. So usually there can be everything from underwriting fees. That's the one. Underwriting fee is the one standard fee. A lot of lenders will have processing fees. They'll have sometimes even application fees. That's more of what I'd consider a junk fee. They can put all sorts of stuff. If you look at a loan estimate, it's section A and B is where you want to look at those lender fees. On the title fees, it's usually section B and C, depending on the situation. Section E will have the government fees, and then the rest after your prepaids, so you don't have to worry about that. And then G is going to be your escrow account, and H is going to be any other random fees that you have. So the main thing to focus on for the lending standpoint is section A and B, mostly section A. And so what lenders will do, or brokers, and we can do this, I built the tool. We're the only ones I can find on the internet that has it, and you can go on our website and use it yourself. We usually do it for you because it's a little in-depth, but we put it out there so you can use it. Again, I couldn't find it anywhere, so I built it. And we call it a lender paid closing costs because we're trying to be transparent about it. So again, getting back to that 5.75% interest rate, you come to us, hey, this is where the rate is. Again, rates too, they vary based off of your credit, based off of how much of the house you have paid off, based off your income, your debt. All those things will affect you. So you will not have the same interest rate as everybody else. Everybody, just like the purchase, it's going to be dependent on a lot of things. But what lenders do, or we can do, is say, okay, the title fees, underwriting fee, blah, 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 all these things combined are usually, I'd say in Minnesota. New York is totally different, by the way. Your fees are going to be super high because that's a whole nother story. We're not in New York, so I'm not going to go into that. But Minnesota usually is about $3,000 to $4,000 for the actual loan fees. If you're escrowing your loan, it could look like $7,000, $8,000, $9,000. But escrows, those offset. So your current lender, you're escrowed, they're paying your property tax and insurance, or just one or the other. They're collecting for that. That's not a loan fee. That's more noise, and it's going to be the same at every lender. And, it's not lender specific. And whether you refinance or not, it's going to be the same amount. It's going to net out. So we won't really talk about that too much because that's not a fee. That's a service that's being provided for free. So the main thing to look at again are those title fees, government fees, and lender fees. When you look at those, what lenders do is they will add all those together. Let's say it's $3,000. They will add that either to your loan amount. So if you're refinancing and your loan balance is $300,000, they will update it so your loan amount is $303,000. The difference in that $3,000 on your payment is going to be very minimal. It could be, again, depending on the interest rate, it's probably going to be somewhere between like a couple dollars to maybe like, $10 to $15 a month, maybe a little bit more than that, but it's going to be very minimal to add that closing cost into the loan balance. So your loan balance goes up, which is important to know. It's not necessarily a negative, but it's important to know. That's one way. The advertised way of free refinances is they will take that $3,000, add it to your interest rate cost. So if you're getting 5.75 at no cost, they will add that in, and depending on your loan amount, let's say your interest rate goes up to 5.9. Well, now they'll say, okay, we're going to give you a free refinance. Here's your interest rate is 5.9%. So, but what they don't tell you is you could have got a lower interest rate if you paid it yourself, or if, it could have been possibly better to roll it into the loan balance. It's all going to be dependent on your specific financial situation. And the biggest thing is if people are giving you answers before you've explored all the options and told them your priorities, they're selling you 100% because they're just here to make a sale. It's not dependent on you, and they're just trying to sell their product, which is fine. But again, as I always tell you guys, remember, loan officers are salespeople. So yes, they're supposed to advise, and that's our fiduciary responsibility, is to put your financial interest at heart, or, as the number one priority. But also, if they don't talk to you about that, there's no way that they even know what that is. And so when it comes to the paperwork and everything else, if they can show that there was a specific benefit, like lowering your monthly payment, they can come back and always say, well, we're lowering the monthly payment. And so technically that is a benefit. And, it's going to be one of those situations where it just wasn't a good transaction. Now, it might end up benefiting you. You might get lucky, but you really want to work with somebody that's going to break down the different options. And the main three things with that refinance, and I'm kind of going to the next topic, but is looking at your monthly payment, is getting that as low as possible. The most important thing is it consolidating debt, because you have a ton of, I've seen people with over $200,000 in credit card debt at 29% interest rates. So you can roll that into your mortgage at 6%. That's usually cheaper because that $200,000 credit card debt, those people were not getting a hold of it. They weren't like, hey, in 6 months, we're going to be able to pay this off. So they're able to roll it into their mortgage and then lower their monthly debt significantly, and then use that savings to pay off their mortgage faster. But it saved a lot on debt, because a good loan officer is going to be a debt manager. And a lot of loan officers are not, because they just focus again on selling you their loan product. But a good loan officer is going to be in debt management, is going to be their viewpoint. And so they're going to interview you, ask you what your primary reason is for doing this, and then base the refinance on that. So, one example that I'm telling a lot of people right now is the rates did come down a little bit the last couple months. We're kind of sitting in this holding pattern right now. It's not uncommon for the rates to go up after a rate cut, especially dependent on everything that they're saying, which that's a whole nother topic we can talk about another day, and we kind of talked about last week. But we're doing a lot of these like lender paid refinances for clients. And the big reason for that is, and again, if your loan officer is not talking about your break-even point, they should be. They definitely should be, because the break-even point on those are usually the first month. So once you refinance, you make that first payment, you're already broke even. So you're not losing any money if you refinance again in 6 to 12 months. Because again, if it looks like the interest rates are coming down, and you think you might end up wanting to refinance again in 6 months or a year, and again, the prediction is they're not going to drop a lot more over the next year, but predictions are rarely accurate in this industry. Or I shouldn't say rarely, but it's definitely not a high probability. It's kind of here, nobody really knows. If you do that no cost refinance, or what they call no cost refinance, and your break even point is the first month, and let's say interest rates drop 1% over the next year, you can refinance and you will have saved money for basically 11 or 12 months. So you're going to have truly saved money while usually lowering your monthly payment. What's happening right now, and I've been seeing this from a lot of the biggest companies, the ones, if you go online, they're advertised everywhere. They're probably calling you because they buy everyone's information from the credit agencies. They're putting people on refinances where your break-even point, the cost of the refinance is, and let me be clear, a break-even point means the cost of the refinance now has paid for itself. So if the refinance costs $3,000 and you're going to save $300 a month, then in 10 months, you're going to break even, because $300 a month times 10, that's $3,000. So in 10 months, you're going to break even. The 11th month is when you will actually save money. I'm seeing lenders right now up to almost 20 years on the break even point, and the clients are bragging about getting a low interest rate. They have no idea because they don't understand it, and their loan officer is not explaining it to them. Personally, I think it's predatory, because technically they're telling you everything, but people don't understand this stuff, and that's okay. But ask questions, because they're selling them these really low rates in like the 4s and the 5s, but they're paying incredibly high amount of money for it, but they're rolling it into the loan. So again, if we go back to that $300,000 loan balance, they're having you buy down the rate for like $20,000, roll it into the loan. So that's $320,000 loan balance. They give you those lender credits and the higher rate to offset the buy down, to pay for your costs for your refinance. And then they say, hey, look at this. We got you a 5.25 interest rate. We got you a 4.999 interest rate. And it looks amazing because nobody else is going to give you a rate that low. But also that's because nobody else is going to take advantage of the situation like that. So, if you break even in 15 years and you refinance in a year, that's 14 years of money you've lost. So some of these people, if they refinance again in, like, let's say a year, they're going to probably have lost $15,000 to $20,000 in real money, even though their monthly payment has come down, and that's including that in there. So that's a huge part of it, is that break even point. And just, again, ask the lender to explain how they're giving it to you for free. Because if they're playing games with you and gimmicks and they're not being straightforward, or they don't understand it themselves, to me, that's a red flag. I don't want to trust that person with my money and one of the biggest financial transactions of my life. If they can explain these things and break it down for you, then okay, this person is being straightforward with me. They're being transparent, because everything has a positive, negative effect. It's like a seesaw. You can't get the lowest rate for the cheapest cost. It's just not how the world works. So anybody that's talking to you about this or advertising that, again, our compliance company said we cannot even say free refinance, which, again, we explain it on our website. But so my understanding is you're not even supposed to be writing that. And so that's for their compliance team to handle. So
it's not free. You're paying for it. So Yep. So that is the thing, because whenever you refinance, any fees that you're gonna end up paying is gonna be rolling in your equity. Whatever equity that you made, that's when they're gonna put it for you. So another thing that I have seen, when you refinance, let's say you paid. So as you guys know, let me disclose about me. I am not a mortgage broker. I am a real estate agent. That's why I have a licensee mortgage broker that can come and explain to us about these things every Wednesday. So whenever we refinance, let's say if I live in that property for 10 years, I would not go back to a 30 years mortgage again. So I don't know if you know, it's the first 5 to 10 years, your principal and interest payment, you pay less on your from your I can't even think, your principal, you pay less on your principal and you pay more in your interest. So when we refinanced, me and my husband, what we did is we lived in this property, the one that we live in right now, for I think it was like 4 years. And then we decided to cut it. And when we refinanced, instead of going back to 30 years, what we did is we shrunk it to 15 years. So at that time, you pay less interest rate and you pay more in your principal. And there's a lot of benefit with it. And then, your mortgage payment might be a little bit, a little bit higher. So whenever you refinance, there are terms, like the year terms. There is 5 years, I think there are 7 years, there is 10 years, there's 20, and there is 30. I think Peter will explain to us those things. But like when you refinance, don't go back to 30 years. Ask your lender that, hey, if I go to 20 years term, what will be my payment will be? And, if I go to 15 years, what that look like? So trying to make your lender to work for their money. You're paying them. So they're not literally giving it to you a free labor here. So ask question, understand the terms and regulation, and go on. So what I wanted to ask Peter is, what are the year terms that in refinance?
So usually the lowest term most lenders offer is 8 years.
Okay.
So yeah, and that's usually so it's usually 8 years. There might be lenders that do less. I don't know every lender out there, and but yeah, usually the standard is 8 to 30 years. Some lenders, like Ida was saying, they can put you in a specific year. I'd say, it's, again, I haven't told this, but I know the lenders we work with, I should speak to, I know we can do that. We also can do things like do your rate down to the 1,000th of a point. So we can do 5.964. A lot of lenders will only do 6%, 5.875, 5.75, 5.625. Yep. So sometimes when they can't do the specific rate, you're either going to pay a little bit for that rate or you're going to get a little bit of a rebate back. We can zero it out. So say your rate's exactly, again, just making up numbers, but 5.962%. Whereas the other lenders they'd say, hey, you have 6%, or you got to buy it down to 5.75. But yeah, one of the benefits from that, and I just built a calculator because again, a lot of this stuff in this industry, even for us as mortgage professionals, does not exist unless your company makes it. And again, because the main part is to sell to the client and get the loan closed, most lenders do not focus on getting super in-depth in analyzing your situation, because they know that whether they do an hour's worth of analysis to really break down your options, or they do 5 minutes, the most of what people care about is, what is my interest rate, and I want to get my monthly payment lowered. Yeah. So again, going back to the last example I had, I've seen people where they're going to be paying hundreds of thousands of dollars more over the life of their owning that home and having that mortgage, but their monthly payment's going down, and they don't realize any of that because nobody told them. So if you're really in a situation where monthly payment is the most important thing, then yes, that might be a good option. If that's the difference between you being able to pay your bills or not, it's probably a good option, because you don't want to lose your house. You don't want to, have other issues like that, but it is definitely not ideal. And again, this can all be tailored to you. So, one of the biggest things, if you're trying to lower your monthly payment, like Ida was saying, is you can go back to 30 years. Even if you've been paying for 10 years, you can go back to a 30-year payment. That'll lower your payment because it's over a longer period of time with this new, hopefully lower interest rate. But if you extend that term back another 10 years, you're going to pay a lot more in interest. So that's good to know. Now there's ways to offset that as well. If your loan officer knows what they're talking about, they're going to tell you, hey, you can make monthly payments. We could plan to refinance again down the road. Once you're in a better position, let's get you on your feet. Let's get you solid. Or you might know, hey, I'm selling this house in a year or two anyways. It doesn't matter if I go back to a 30-year. I just want to get my monthly payment down right now. And I won't be paying that much more in interest because I'm going to sell it in a year or two. So again, these are questions that you should be having with your loan officer and discussing. And they should be bringing it up to you. But if they're not, you should bring it up to them. And you can usually tell pretty quickly if they know what they're doing. So, and if they can answer these questions. If you're calling a call center or any big company, you're probably not going to get that, because even the call center people will get in trouble if they answer too many questions with you. Now, technically, that's not written down anywhere, but I know enough people that work at lenders. It costs the same. They make the same amount of money whether you ask one question or 100. So the person that's asking 100 questions, see ya if they're busy. If they're not busy, then yes, they'll spend the time. Anyways, getting back to this though, all of this kind of circles back to the point that you need to be having these conversations with them and not just what's my rate. Because as I said last week, as I've said many times, these lenders, as I said earlier today, these lenders are selling you, some of the lenders, the standard is to add 2 points in cost. So if you have a $400,000 loan, that's an $8,000 rate buyout. So if you call them and say, what's my rate? They'll tell you it's 5.75. You call us, I'm going to tell you what it is at par or what it is where it's no cost to you. So, and again, getting back to those lender paid closing costs refinances that are free, which aren't truly free, but they're advertised that way. We're actually doing a couple of those right now for clients, but we've explained all this to them. And again, the reason is because we think that the rates are going to continue to come down over the next 2 years. You as the client have the final say, but it looks like they're going to come down over the next couple of years. So they want their break-even point to be very, basically the first month of their payment, they have that new refinance completed. So that way, if the rates do drop in 6 months, 12 months, 18 months to a point where they want to refinance again, they didn't lose any money. Now they are getting a slightly higher interest rate, but it's still enough to save money on their monthly payment. It's still enough to hedge against if the interest rates come down, so they're not going to lose money. Yeah. So, and like some of them have arms. They want to get out of the arm. They have a 5-year arm or a 7-year arm. They're 2, 3, 4 years into it. They know they need to refinance the next year. And so they're like, you know what, even though the interest rate hasn't dropped to 4 like I really, really wanted to, I can get it a little bit lower. I can get out of the arm. And now when the rates come down further, I'll look at refinancing again, but this will prevent me from having that sunk cost or losing, potentially thousands or tens of thousands of dollars on that rate buy down. Yeah.
Mm-hmm. You guys heard them. So it's kind of eye-opening. A lot of people don't have that information out there, or we don't know. It does not matter how educated you are. I think mortgage, real estate business, life insurance, and all that, they all have a different way of their thing. Okay. So if you ask me about anything about insurance, health insurance, life insurance, whatever insurance, it comes out our here that goes in, but it comes out fast because it just doesn't comprehend with me, right? So another thing that I wanted to ask you, Peter, is, me and you, we work for ourselves, right? A lot of us, we work for ourselves. And as soon as we purchase our property, we kind of change our income. And, we trying to pay more or claim more that we have, expenses, right? So when we wanted to refinance our home, we have to go do the same structure, the same strategy when we purchased our property. They're going to check your income. They're going to check this and they're going to check that. So would you explain it short and sweet about income? What is the income? Do we have to have an income even to refinance? Because, hey, I already got my house. Just refinance and drop my price for me. That's what I want. And what are the requirement on that about income? Because we always running into this kind of issue, even purchasing or refinancing. So would you give us a little hint?
Yeah, definitely. So that's a fantastic question. And yep, so like I was saying before, when you refinance, you're paying off your old loan and starting a new one. So think of it like you're returning the car to the dealership and you're getting a new car for usually a better price, but again, depending on your situation and your priorities. And so when it comes to the income side of it, I shouldn't say the only, but the main two types of refinances that you might not need to show income is if you have a government loan. Well, we'll just put it under that umbrella. If you have one of those government loans, USDA, FHA, VA, for instance, FHA is probably the most popular one. VA has what's called an IRRL, IRRRL. It's an acronym, but they're called streamlined refinances. And what they are is if you already have an FHA loan and you want to refinance to get a better rate, usually the costs and the fees are cheaper. We can use a soft credit pull. We never have to do a hard credit pull. We can close it with the soft credit pull. And the reason why we can do these is because they're already with the government. And if you're refinancing, backed by the government, and when you're refinancing the same loan that's backed by the same entity, the government in this case, they're like, all right, we're going to try to make it cheaper and easier for you to save money. But we need to see that there's a clear benefit to you. So that's one thing on just side point. That's one thing on every refinance. We have to put in the paperwork why you're refinancing. So when you go through your documents, if you're not comfortable with your loan officer, you're questioning things and, whatever, or if you just want to double check it, there is a form in there. And if you can't find it, just ask your loan officer and they'll get it for you. That explains why you're doing the refinance. Because in the past, there is something called churning, where loan officers just try to get people to refinance because we make money when you close. So it's really for the loan officer, not for the client. And that's why, that's a speculation why some of these lenders are selling you so many points to buy your rate down. One, they don't want you to refinance it right away. So if you buy your rate way down, it's probably going to take longer till the rates come down. So that's going to protect it and keep the loan open longer. So they're going to make more off your interest. The other thing is then they're going to beat everybody else out. Because again, if you call me and interest rate is 5.9% with no cost, and they sell you 2 points and they forget to mention that, and now they tell you it's 5.25, you're going to go with the 5.25 because it's better. But if you don't have those details, you're not going to know that. So getting back to the income part of it, though, when you're doing this new loan, they got to check those things. They got to check your income versus your debt. They got to check, your whole profile to figure out, can you still afford this payment? And again, with the FHA loans, like those streamlines, we actually don't have to get income. We get a credit report, so we get your scores. We also get the mortgage history. A lot of times we get the full credit report, but the main thing they're focused on is your mortgage payment history over the last 2 years to make sure that you don't have over, for FHA, usually it's not more than 2 late payments in 2 years. But depending on the situation, it could be less than that, which is why I always tell people try not to have any, because even if you have one, that could cause a problem. And so those are the exception, though. And those ones we use soft credit pull, your credit score, maybe have to do an appraisal, maybe not. A lot of times we get a waiver, as long as you're not doing like a cash out, you can't take cash out on a streamline. But it's very minimal, and then the fees are a lot cheaper too, just because it's so straightforward and so simple. But your standard refinance, you're going to have to check your income. So if you, like for self-employed, if you claimed $120,000 last year, that's roughly $12,000 or $10,000 a month. Well, this year you wrote off all of your expenses because you're like, I'm not buying a house anymore, and you only claim $60,000 in income, your income got cut in half from $10,000 a month to $5,000 a month. So, and I wouldn't be able to tell you if you still qualify for the loan or not without seeing everything, because I got to see what your debt is at, your other debt outside of the house. I got to be able to see what your total monthly payment is. Because if you have a $600,000 loan, that payment's going to be a lot higher than a $300,000 loan. We got to look at your property taxes, your home insurance. If you have homeowners association, we have to look at that debt, because that is required every month. So that counts towards your debt. So if you are self-employed and you're thinking about doing this, or again, it looks like the rates are going to be coming down over the next 2 years, you might want to think about that and say, okay, how much income am I going to need? And that's where you're going to want to reach out to your loan officer and have them help you figure that out. Now, one big piece of that will be the interest rate. If your interest rate is 3%, you're not going to need as much income because your payment's going to be a lot lower than if you're looking at 5%. So that's the one thing that your loan officer is going to have to kind of estimate with you, but then they should be able to break that down and say, okay, if it drops to 5.5, your income needs to be here based off where you're at. If you're at 5%, then it only needs to be here. And also remind you, don't take out any new debt. If you go buy a car and now you got an extra $800 a month payment, that's going to throw everything off. So, but again, they should be able to walk you through those things so you can prepare. And that way, you know, if you're hoping to refinance next spring, then you can get ready. You could even wait to file taxes if you're self-employed and say, all right, I'm not going to usually file first week of February. I'm going to wait until, you know, first week of April to kind of see where the interest rates end up. Because again, none of us know where that's going to be. We could be looking at 5% interest rates. We could be looking at 7% interest rates. It looks like it's coming down, but the world's crazy right now and nobody knows for sure. So.
Okay. So I wanted to clarify this. So when you said the VA and the FHA loan, you said that they don't have to check their income, even though if they cut down their income?
If they, yes, if the simple answer is if they qualify. So you still got to have, your credit is still a big deal. Those late payments are still a big deal. If you got like 6 late payments in the last 2 years, highly unlikely you're going to be able to refinance with anybody. And then again, if your credit score dropped to 400, you're not going to be able to refinance probably with anybody. So you still have to qualify from those angles. But if you qualify for that streamline, when you call your loan officer, they'll check it and say, yep, it looks like you qualify for a streamline refinance. Like I said, the VA is called an EARL. Then we shouldn't need those things. Again, but this is a loan approval. So if something comes up throughout the process, then they might say, okay, now we do need it. So it's still not a guarantee. They might say, all right, we can't do it this way because this came up, this came up, this came up. All right, so now we need to do a full refinance and not a streamline. And then that they can ask for those things. So it's not a guarantee, but you know, if your credit is solid, if your income or if your credit's solid, you've been making your payments on time, you've been paying off the house as you need to, that type of thing, usually you should be able to qualify for it. Now, a lot of times, like I said, even with those, you also get an appraisal waiver. Usually the underwriter fee is about half of what it is for a traditional refinance. Some of the other fees like title and things like that can be a little bit cheaper. So those ones are usually on the cheaper end. The other thing to bring up too is remember, government loans have a finance fee. FHA, it's always 1.75% of the loan balance. VA, it depends on how many times you've done it and also how much the loan you have paid off, what your loan to value is, or how much equity you have in the property. So they are a little bit different in that regard. But like FHA, for example, that 1.75% fee, you pay that on the purchase. You also pay it on the refinance. But if you refinance within 3 years, you get a refund based off of how soon it is after you purchase. The closer it is to purchase, your purchase date, the more of a refund you'll get. So like I have a client right now, they're doing actually 2 of them, they're doing an FHA refinance. They bought their houses in January. They're refinancing right now. Minimum time that you have to wait for a FHA refinance is 210 days. One of them is just hit 210 days. The other one hit it a couple weeks ago. But because they're refinancing so soon after they closed, they're getting I think it's 66 or 68% rebate on what they paid for the FHA finance fee. So that also helps bring that cost down, but you are still paying that fee. So that should still be factored into the refinance. And that's for streamlines, that's for regular FHA refinances, cash out, everything. Conventional is the only one that does not have a finance fee because it's a loan through Fannie and Freddie, who are not government. They're connected to the government. That's a whole other conversation, but they're not government backed.
Yep. So, okay, that is a good one. So I need you to break it down this for me, that I'm thinking what I'm going to ask you. So I think we have 27 people on TikTok and 4 people on YouTube. So TikTok people, would you please tap the screen for us up to like at least 10,000 and go on. It does not matter if this information is important to you. I think that's the only thing that you can do as a favor. Just tap the screen, my screen, you just tap it, like, whatever, as much as you can, and then copy link it as well. So let's say I'm going to give you a scenario. Let's say I have a FHA mortgage and I wanted to refinance it. And then when I refinance it, I want it to be conventional. Is that an option?
Yep. So that is a great point as well. So a lot of times FHA, that was a loan product that they created to try to help people purchase a home who couldn't get approved for a conventional loan, or the conventional loan was very expensive. So now conventional does have 3% down for first-time home buyers. But even before they had that, FHA had 3.5%, which was the lowest for a while. So that was one benefit. Number 2, mortgage insurance, especially if your credit score is under 680, is significantly cheaper for FHA than it is for conventional. So if you're putting a low down payment and you have a lower credit score, usually FHA is going to be a better loan product, even though you're paying those fees. But like when you go to refinance, if let's say you've worked on your credit, now you're at 700, 720, 740, something like that. You've paid off some of the house, things like that. You can get rid of that FHA loan and refinance to a conventional loan. The big benefits there, you're not paying the that 1.75% finance fee for FHA. The second big one is for FHA, a while ago they changed it. So you're paying mortgage insurance for the full 30-year term. For conventional, once you've paid off 20% of the home value, then you don't pay that mortgage insurance anymore. So if it's $100, $200 a month, something like that, I've seen clients up to $600 a month who had to do conventional. Well, that's a different situation, but they were paying a lot because they had such a large loan, low credit. They only had one option because FHA didn't have loans that big. So I guess getting back to your question about FHA to conventional is to get rid of that mortgage insurance. That's probably the number one thing that most people in the public know about, is they'll say, hey, I've paid off 20% of my house. Mm-hmm. I really want to get rid of this mortgage insurance. The rates are coming down. Let's refinance to conventional, avoid that finance fee, avoid the mortgage insurance. And now I'm going to get hopefully the best rate I can get. So yeah, that's the big thing with that.
So when I change from FHA to conventional, they're going to do the whole process. They're not going to do what the process with the government.
Streamline. Yep.
Okay.
Yeah. So they will check income, assets, credit, all of those things, just like when you purchased. But the big difference with the refinance, like I said, is you already own the house. So it's usually a little bit easier to do it. But it's still not a guarantee. So, and I did see a question on here. Let me scroll up here.
Before you answer, this is actually that I just learned that today. Even though that I am in the real estate, yes, because I did not have no idea. I have heard it when people say it, but that's the question that I want all of us to learn today. That's something that, that's why I love real estate. You just learn stuff every day, every hour, every whatever. So before you can read the question, but I would like to have the audience, actually, we have 28 of us here. If you guys are thinking that this is an excellent information for you guys, I think what you guys can do as a favor to tap the screen. I should not say those things to you guys. I think this is a common sense for all of us. We give free information. You give us to just tap the screen. That does not cost you guys a penny. You know, you're getting the information that usually people would charge you money for this. So this is just serious stuff. I go through this thing every Sunday and every Wednesday. I think when you come and trying to listen this information, humanly, we just give stuff, and we're not asking to give us a gift, or we're not bribing you to guys to come here and listen to us. But I think that's the list stuff that you can do. So interesting. So anything that you guys have learned from us, one thing that I really want you to guys to do is what? To take that, research it, understand the process. And we always say, ask question. And also, before you sign any document, I need you to ask the person that who made you to sign a document. It can be a loan, it can be a real estate agent, it can be insurance guy, it can be whomever that person. You really need to ask question and go forward. And so if you guys are tapping the screen, at least to go to 10,000, we appreciate it. Then you can go on beyond that. And I think some of you guys are tapping the screen. You guys are accidentally asking to come in. It's okay. Go for it, Peter. I don't know what you were about to say, but okay. I got cut you off. I think you had a question.
Yeah, it looks like it's from Frida. I saw she just requested to join, so maybe she wants to ask a question live. But so if you want to, just ask Ida to get back in here. But yeah, so you're asking how to find the best. How do you find the best lenders to compare interest rates? So there's a lot of ways you can do that. You can go online and shop around yourself, and there's a lot of different tools that do that. Some of them, I guess I won't get into all that, but some of them will actually give you the best lenders. A lot of them, they have partnerships, so they give you the best lenders in their partnership network, or there's ways for those companies to pay to seemingly always come out near the top. The biggest thing I would say with that is, and this is just based off experience talking to, many people over the years, it's really hard to get a true accurate estimate for a couple reasons. One, not everybody's rates are quoted the same. When you go to those rate quote sites, especially if it's not from the specific website for that lender, they're assuming some things. Now, if you want to read all the fine print and you want to click around and look, and you're really good at that, then you can probably figure it out. I do this for a living. I go to those sites, and sometimes I have to sit there and look for like 5 minutes before I can find everything, because I know they're not showing me something, because it doesn't make sense, because I know how this works, until I can finally find it somewhere. And sometimes you got to click this link to go to this link, and then there's like a whole page of this fine print in size 6 font that you got to read through the whole thing, and most of it's mumbo jumbo. But in 3 different spots on that full page of mumbo jumbo, it'll show you, it'll be like, oh, we're assuming that you're paying $10,000 for a rate buy down, or they usually say points. So because points, the dollar amount changes based off the loan amount. So say we're assuming that you're paying 2 points. Well, that's not an accurate estimate, because again, if you call me, I'm not going to quote you 2 points. I'm not going to quote you, $6,000, $8,000, $10,000 rate buy down. I'm going to say, here's where the rate is. Then again, first though, we're going to discuss all those other things. What are your priorities? What is the goal here? Because if you don't know your goal when you go to refinance, that should be a red flag in your own mind. Define your goal. Because a lot of times the lowest monthly payment is not the cheapest loan over the full life of the loan. So, if you have a lot of money and you want to pay this off as fast as possible and pay as little interest as possible, the lowest monthly payment, that's not the lowest monthly payment. You're probably going to want to go to like a 10 to 15 year loan term And again, I won't go into all that because that's a rabbit hole or rabbit, trail. But you want to define the goal and then be able to work towards that with your loan officer based off of what they're asking you. So again, getting back to this lender quotes and everything else, you can go online, you can shop around, but some of them are quoting 1 point, some of them are quoting 2 points, some of them, almost all of them are estimating that your credit score is 760 or 780 or higher. Every 20 points especially on a refinance is important, or if you're a repeat home buyer on a purchase. So that can change your interest rate. Usually your debt to income ratio won't, but some lenders, they will charge you a higher interest rate for that. So you can price it out on there, but many times at the end of the day, it's going to come back way different. And then if you have a loan officer who's just focused on selling you, they're going to try to sell you that 2 points. From what I've heard, they're not going to tell you that you're buying 2 points. They're going to expect that you see that on the paperwork and you realize that's what's going on, or they realize they're rolling it into the loan without telling you. And so what my opinion is, maybe I'm biased because I'm a mortgage broker, but mortgage brokers work with many different lenders. They have many different relationships. We also, we get pricing from, I think it's like 280 lenders. But we don't work with all 280 because some of them do really bad work, or things constantly change and create a ton of stress or get people denied. I had a lender that we worked with recently. They're becoming very popular in the broker world. They have a retail team, so they have their own loan officers that will call you. They also work with brokers like me. And they promised me the world. Oh, they compared themselves to the biggest lender in the country. And they said, oh, we got better rates than them. We're just as fast as them because that lender is very fast. Basically telling me they're basically better than this big lender. And I've been hearing a lot about them for the last year or two. People have been telling me, oh yeah, this and that. So finally we had a situation. I had a client, it was a friend of mine. And I said, hey, do you want to go to this lender and try them out? They're making all these claims. I'm kind of nervous about it, but do you want to try them out? Yeah, let's do it. So we do it. We send the loan to them. It was a little bit of a trickier refinance. Before I ever sent it to them, I sent them the details. I said, here's the issues that are going to come up in underwriting, because I used to train underwriters. I used to audit them. So I'm usually pretty aware of what they're going to be looking at. I said, these are the issues that are going to come up. Are these going to be a problem? They sent it to supposedly a vice president in underwriting, came back to me 3 days later, said, yep, we're good. That's not going to be an issue with us. We're just going to have to get some extra documents, but we're good. Okay, let's do it. Do all the work, send them the loan, we put everything together, send the client the disclosures, get the whole loan process started, and then a couple things come up that we weren't expecting. Oh, well, we just want updated paperwork on some of this. We just want to double check a couple things. Okay, all right, we get them this, we get them that, we get them this other thing, all things that they told me they didn't need. All right, sounds good. Finally, the day comes. I'm going to a closing. Friday afternoon, I get a call. Underwriter calls me. Hey, I just want to give you the great news. You guys are clear to close, fully approved. I'm going to send you the email in a couple minutes. Get ready to close this on Monday or Tuesday, whenever the client wants to. We're good. All right. So I'm about to get to the closing. I'm about to walk into the closing. So I didn't call the client, thankfully. Go to the closing, get out of the closing, and go to call the client. And I realized I still have no notifications that we actually were fully approved. So I call the lender back and I'm like, what's going on? I didn't get the notice yet. It's been like an hour and a half. I thought it was going to be a couple minutes. No response. Left them a voicemail. They didn't answer the phone. Sent a couple emails. Didn't get a hold of the underwriter, but I got a hold of somebody else. They're like, let me check on it. We go, never get a response. Saturday comes, no response. Saturday afternoon, I think I got a response saying, oh, hey, I forgot to respond to this yesterday, but management had to sign off on something. Not a big deal. Usually management has to sign off on things sometimes. It's normal. All right, sounds good. Kind of annoyed. Still glad I haven't told the client yet. So I'm like, all right, I'm going to wait until we officially get this, especially because I haven't worked with this lender before. Monday comes, still no approval. Call them Monday around noon. Hey, we're still working on this with management. They're just taking their time. So they still making it sound like it's just normal business. Okay. Monday afternoon comes, still nothing. I'm like, okay, this is getting ridiculous. What's going on here? It's like 4:00 Monday. Oh, well, yeah, there's just something we got to, get through. We're working through it. It's just a little bit bigger deal than we thought, but still should be fine. I think it was Tuesday finally. They came back. Yeah, so there's kind of an issue here. The same thing I brought up to them. It's almost been a month now. That was the other thing. They told me we could do this refinance in 2 weeks, which is very normal. 10 to 14 days for a refinance is very normal. It's a month later, and now all of a sudden, oh yeah, blah, 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 blah. Thursday comes, I get a call from the senior vice president in underwriting and compliance, and she calls me and tells me, hey, I'm really sorry, but there's this issue came up, boom, boom, boom. And I'm like, yep. So I brought that up to you guys before we ever talked to you, before you ever sent you the loan. What's going on here? Oh, yep. Well, that is an issue. And I'm like, well, what about the other issue then? I brought that up too. Those are kind of combined. What's going on here? So is that an issue too? Yep. Well, because of that issue, then we can't do the loan this way either. So again, they're still not saying it because they're so ashamed. So I say, so the only option here is to deny the loan if I'm hearing you right. So we're not fully approved. You guys are actually denying the loan. And she goes, yep, that's the only option. We don't have any other options. I'm really sorry. We made a mistake. We're working to fix it. And with our team and train them and this and that. And I'm like, but when I called you guys, the person I talked to had been an underwriter for 30 years, she told me. She took it to her vice president of underwriting. They looked at it. Vice president of underwriting is not just a random person. That person has been in the industry a long time. They know all this. They should know everything that they're doing. Yeah, I don't know how they came to that conclusion at the time, but this is where we're at. And, it is what it is. I'm really sorry. And then the craziest part is she had the audacity to say, but I really hope you'll send us more clients so we can close some loans for you.
Are you out of your mind?
I didn't even respond to that. I was just like, all right, see you later. And then we took the loan to a different lender. We got it done. It's closed. It's done. But that's another reason why brokers, I know it's a long story, but that's why as brokers, we vet who we work with too, because there's one lender that offers better rates than everybody, but it is that kind of experience. It's horrible. And if you're purchasing a home, expect for it not to close on time. Expect the costs and the fees to go all over the place. Expect the communication with the lender to be horrible. And us as a broker, we're here to help walk you through this process. Yeah. And we're also cheaper according to government data. So it's cheaper to use somebody that's going to hand hold you and walk you through the process. So I don't know why people go to retail. I guess they know the big names. But a good broker will walk you through that. And so when it comes back to the pricing on your question, go to a good broker who's going to go through, all these type of questions and interviewing you to understand you and your priorities and help you figure out the best financial decision for you based off those priorities. Find a broker like that, and then we will do the shopping for you. We will go figure out which lenders are good. They'll actually get it done on time, give solid rates. Might not be the best rate, but it's going to be close. And then again, you're going to get that whole experience, but you got to find somebody that you can trust. Just like if you go to a foreign country and you hire a guide, who you hire as a guide is very important. If you hire somebody that's going to take you down a dark alley and get you robbed so all his friends can steal your money, that's not a good situation. And that's kind of what this is. And you can go to the country and not hire a guide and try to figure out everything on your own. And that's what a lot of people do too. I have a client that just left us for an online lender that's giving really good interest rates, but the reviews on them are horrible, absolutely horrible during the loan process, after the loan closes, in servicing. Like, it's some of the stuff I don't even know how it's legal because there's laws in Minnesota against it, but they wanted the best rate. And I guarantee they're going to regret it because I've talked to other people who have used this lender and they regret it. So clients tend to hyper-focus on the interest rate and the monthly payment. You go to a good broker, they're going to be able to look at everything with you. And there are good lenders, too, that will do that for you as well. But that's where you want to vet them, and you don't want to just call a call center because I bank with whoever, or they called me first and told me I had tens of thousands of dollars at my fingertips that I could get tomorrow, and that type of thing. Don't fall for the sales pitch. Find somebody you can trust, and then use that person for your life. Because when you call them in 5 years, and you, just like your realtor, if you buy a house through Ida, I mean, she has clients that, 10 years later, they call her, hey, yep, I bought the other house through you. Now we're going to move for whatever reason. Or we want to buy another house. So we just had one like that recently. And that was before I worked with her. So I hadn't worked with them in the past, but they came back to Ida. I liked working with her. Do the same thing with your loan officer. Find a good one and then stick with them, because when you call them up 3, 5, 6, 7, 10 years later, they can go through your information, and then you know somebody that you can trust. So that's my long answer to, how to find the best rates. Find the best overall scenario, because again, if they're helping you take your own finances seriously and will guide you through that, just like going to a foreign country, do you just hire the cheapest guide? It's up to you if you want to. Everybody's different, but when it comes to your finances, especially the biggest financial of most people's lives, I'd say go for quality over, getting an eighth better interest rate, if that's the case.
Yep. Thank you, Peter. That's why I always say, interview your agent and interview your lender, whomever that you're working with. When you end up interviewing those people, and you have some compare analysis. Oh, you know what? This lender gave me this information and this one did not, but this one gave me all the information that I need. And which one is in detail about their job. Okay. And the same thing with real estate agent. When you hire a real estate agent, interview them. And that's what we usually do. I have a bunch of people here that I deal with, Texas, Colorado. I have some in Virginia. I have in California and DC, Atlanta. And I have some people who is just moved from Atlanta to here to Minnesota that I'm helping right now. So the people that who are out of state, we have a questionnaire that we can help you to hand you that information, that for you to use those guidelines to interview your agent or your mortgage broker. I think a lot of us, Fatiab says that, how can I get a lender that will give us a lower interest rate? Believe me. Sorry, I got a phone call. Sorry. So if I know that for my buyers, there is certain group of lender will give a good interest rate, forget about Peter. I'll go with somebody else. I'm like, hey, they give them, it's all about benefits, right? If your clients are happy, wanted to get this thing done, and this is what we wanted to do, right? So what I want you to think of is your interest rate, it goes by your own history. Your credit score matters for your interest rate. It does not matter if you wanted to finance. It does not matter if you wanted to buy. If you have a 620 credit score and you wanted to come and buy property, your interest rate, it would be higher than someone that 750, 760 score. As you know, I am not a mortgage broker. Peter is. I am a real estate agent, but I am telling you this thing with the experience that I have seen. And also how much that you're going to put down. And another thing is your debt. If you have a bunch of credit card, a bunch of loan that you put in, and your income is kind of low, that's the stuff that there's a lot of stuff that comes with it with your interest rate. So one thing that I wanted to say, and I'll be quiet. We have actually 15 minutes. If you guys have a question, you guys can come on the stage and ask. When you go and get a credit card, Do you check your interest rate? Do you know that your credit card interest rate you get charged every day? Do you know that your credit card interest rate fluctuates every day? It's not a fixed rate. So I don't want you to just stuck on interest rate. I think that's why right now the media, their agenda, it's an agenda. They don't have nothing else to talk about now. Interest rate, interest rate, interest rate. I'm like, yesterday I was at my son's soccer practice. That's all the stuff that they were asking. How's the interest rate? I was wanted to rent my house in Savage and wanted to move to Eden Prairie, and I'm like, there's no difference than what we have like 3 years ago. It's still the same, but the interest rate went down last week, right? But the Fed interest rate, there is nothing that got to do with your mortgage interest rate. So I want you to dig out this information. There is so much false information out there, and that's why we are here to break it down to you. So,
Yeah.
as a conclusion of our conversation today, if you don't have no question, what is Fed interest rate is to us? Would it that matter with our mortgage interest rate? Would that even actually will affect it actually the worst? But what is Fed interest rate is? Whenever they say that, oh, I'm learning this thing, by the way, as you guys, because I don't do mortgage. I'm learning this thing as we go, and ask Peter. Peter always like give me those information, and I swallow it. I try to go and ask Chat GPT how this started working, and please help me out. But Peter will explain to us. I think Mickey made a video last week that he really dissected and explained it in Amharic. But Peter will give us a clue what's going on for, precise 5-minute stuff. Then we say bye to our audience, and then we go from there.
Yeah, so I'd say like to go back to like the reason why you're refinancing is really important. Are you trying to lower your overall total amount of interest and debt that you're going to pay? That's usually for people who have a lot of money or a lot of money in their hand, and they're like, hey, I want to pay this off faster. That's where sometimes when the interest rates go down, you might go from a 30-year loan and you got 25 years left, and they'll go down to a 15-year loan. Also, if you do go to a 15-year, usually it's about 0.5% better interest rate than a 30-year. Not guaranteed, but usually, depending on how the pricing works. Do you want the monthly payment to be as low as possible? Is that the key? Because in that case, you're going to be paying more debt.
Yeah.
Because the 15-year payment's always going to be more than the 30-year payment. And that just makes sense, because if you take out $300,000 and you pay it off in half the time, you're going to pay a lot less in interest because you paid it in half the time. Or is it, you want your lowest overall cost at closing? Let's say you're like, I have no extra money right now. I do not want to pay a dime at my refinance, or I want to take money out of my house. Those are all different situations. If you do a cash out refinance, where let's say you paid off half of your house, but now you want to take out a bunch of money, like 50 grand, 100 grand, your loan balance is going to go up. Your payment's probably going to go up, even if the interest rate came down slightly or is the same, just because you've taken out a bigger loan. So you also want to look at those different type of things too. And you don't necessarily want to take money out just to blow it on, vacation, unless that vacation is very, very important to you.
Yeah.
And I guess the better way to say it is that vacation worth taking out that debt? Some people say yes, some people say no, but you want to know the details. You don't want to just say, I'm going to take a bunch of money out of my house or take a huge loan basically for your vacation without understanding it. So that's where your loan officers should come into play. And I'll just show you guys this really quick here. If I can turn my camera around. Let me turn off the visual effect. There we go. Let me get this here. So, okay. So this is my computer. Let me actually do it this way. I don't know. Does that look funny on the screen?
Yeah. Yeah. I just put you
Yeah,
on
we
the
go-
big. I just put you on the bigger screen.
Oh, okay. So this is a refinance tool that I just built and I'm finishing up. Let me go back up here. So, and we're probably going to post this at some point on our website. Right now, we're just using it internally, but it's looking at your mortgage details. So we enter your current information. So everything in here, as far as like what's going on in the situation, your new mortgage details, and it's very detailed. So that's why we're just using it right now and not sending it to everybody. But even the closing costs and then your optimization goals. So most people, it's lowest monthly cash flow or basically monthly payment, and lowest cash to close. Like basically you don't want to spend anything. Lowest overall cost, that's where you're going to be doing a shorter term. You might be spending money at closing, but you're not going to pay as much in interest over the time. Then you calculate it. So down here, this will compare everything, look at the difference in the payments and everything else. Another thing that a lot of loan officers won't talk to you about and that probably aren't even aware of is your inflation adjusted cost or the time cost, time value of money itself. So looking at that, for instance, if you look at this right here, your net actual savings is 20 grand. Inflation adjusted savings is 22,000. Those definitely come into play and are rarely taken into account. Also, you want your net reset cost if you're doing a new term loan versus let's say you've paid off 7 years and then you're going back to 30 years. How much extra interest are you going to be paying on that loan? That's another thing that I don't think I've ever really seen any loan officers talk about. And then you can come down here, you can select a bunch of different options for how to compare these different reports. And then you can come down here just as a bar chart for that. And then your inflation adjusted cost. So you're looking at the difference between your original versus if you did it for the same term. In this case, I think it's a 29-year loan because it's only been paid for a year. And then if you were to do the original versus the 30-year, again, this is all entered above. I already entered all this information. And then if you do this a 28-year or 29-year versus a 30-year and the difference, and then your total actual cost, again, going through those three, and then looking down here, and it tells you best option based on your goals is the original loan or is the original loan versus the new refi. So basically doing the new refi, the 30-year term. And the reason why is it's optimized for the lowest monthly cash flow and lowest cash to close. So again, that's based off of your results. And then you can also download it. It gives you additional things to consider while you're doing it, and then things to be aware of. And then if you want to reach out to us, you can click this button. It'll email us and give us that info. But yeah, so the whole point of that though is to try to capture everything, because like I said, most loan officers don't always go through that with you. A lot of them don't understand it, but we want to look at it from every perspective so that we make sure that we're helping you make the best financial decision. And again, keep your overall debt costs at a minimum compared to your priorities. So again, if you want to get the lowest payment, your debt cost is going to be a little bit higher, but at least then we can show that to you and explain that to you. So then you're aware of it, as opposed to just thinking, hey, I'm getting something that's not costing me anything. It's a reality. Every time you give something, it's kind of a seesaw. Every time this goes up, this is going to go down. Every time this goes up, that's going to go down. So same thing with monthly payment, costs, fees, the free refinances, and all those other things. So again, everything has its benefit, but your loan officer should be able to explain that to you, understand that themselves, and help walk you through and explain to you, okay, you told me your number one priority is your monthly payment. This is why this is the best option for you, even though you're going to be paying more interest over the life of the loan. Or, hey, it looks like you have some wiggle room in your budget. Maybe don't take such a low payment and maybe do this, this, and this will actually save you $30,000 in interest savings. Again, we're going to give the final decision to you, because it's your loan, it's your money, all that type of thing. But it's our job to inform and help walk you through all that.
Perfect. Thank you. That is what we need. All this stuff in my YouTube account, if you guys got here late, and we talked about detail about refinancing, why refinance is good, what do you need to look at, what is not good, what is the pro and con. I'm like, there is solid information that what you guys need. It is in my YouTube account. It's a Gojo Realty account. If you guys go to my bio, there is a link. If you click that, you'll find all my social media in there. And then we'll give you my YouTube account in there. So you can, you can go in there, listen. There's a bunch of stuff in there. Any kind of about real estate thing, you guys can listen. There's some in Amharic and some in English. So with that said, Peter, thank you so much for coming. And as always, every Wednesday we're trying to come here unless if we don't have a closing or if I don't have a showing or if I don't have, we're here as much as we can. Right now it's winter is coming, so we're going to be more often coming and, giving you some a one-on-one of anything about mortgage and real estate. The other thing that if you guys have any question about mortgage, you can send it to Peter, and then he will come up with strategy how we can teach you this thing and how you guys can get some of the information that I think if 1% is need, I think there is, many of you guys are out there that need that information. So I have heard that I got a phone call this past Monday. I was teaching about listing property because that's something that I got like 7, 8 people ask me when I list my property, what do I have to do? I don't have no idea. They told me, to get a cute picture and pricing, and that is it. No, listing, you need tons of stuff that you have to put in order to do what? To list your property. And you need a first impression for the buyers, then they can buy it right away. It can put an offer right away, right? So the past almost 4 weeks, that is the question that I was getting asked. So if you have any question, still you don't understand about refinancing, about interest rate stuff, anything that you need, just send him. Or if you wanted to send me an Amharic, you can do that. Peter, usually, by the way, he communicates with my clients. He translates the language and he sends them text and email. So if you text him something, he knows those characters, what they look like, Amharic words. So he will translate it and try and have the answer for him and then do what he needs to do. So with that said, I really appreciate your time and effort to be here and, sit on TikTok for like an hour and a half, 2, sometimes 3. But I really appreciate you. Would you please, people who have not followed Peter, go ahead and follow him. And then that's how you can find him if you have any question to ask. Second, would you please tell us who you are and what you do? And then I will say the same thing, and then we can close our house today.
Yeah, definitely. So thanks for joining us, everybody. And FYI, there's a lot of good calculators out there. We have some on our website, www.cmm.loans, no.com. You can go on our tools page and it has our calculators page. It has a bunch of different calculators on there that are pretty good, in my opinion. But thank you guys for having me. Always great to be here with you, Ida. My name is Peter Jerf with Custom Made Mortgages based out of Minnesota. And have a wonderful week. And we'll see you next week.
Perfect. Thank you, Peter. Okay, let me say who I am and then we can wrap it up. So my name is Ida Tazara. I am a licensed real estate agent and a team lead in the state of Minnesota. I do commercial and residential properties, and also I manage properties. So if you are any states, anywhere, you guys need any, like let's say you need a loan officer, or if you're looking for a real estate agent or whatever, we're partnering with a lot of them, almost every state. We'll be able to help you guys out to get through your journey, and have a fantastic week. I know this week is, I think this weekend is Mescal, and have a fantastic holiday. And until then, if you have any question, please come back and ask a question, then we can go from there. Thank you so much for you guys. Thank you, Peter. Thank you,